Imagine having the ability to look past market noise and invest with the clarity and discipline of one of the world's greatest investors. Today, we unlock the secrets behind Warren Buffett's timeless strategies that can transform your financial future. Welcome to the journey of investing like Buffett. Chapter 1. The Buffett Mindset, Patience and Discipline. In the world of investing, patience is not a luxury, but a requirement, a steadfast commitment that separates sound decisions from impulsive reactions. This chapter illustrates that the Buffett mindset is built on a foundation of discipline and the unwavering belief in long-term growth. Consider the story of Michael, a middle-aged engineer who, after years of chasing quick returns on volatile stocks, decided to adopt a more deliberate and measured approach. Michael began by systematically reviewing his expenses, carving out a fixed portion of his income for investments. Every month, without fail, he transferred 15% of his paycheck into a diversified portfolio of quality companies, a practice he kept religiously regardless of market turbulence. This simple act of consistency, free from emotional market swings, became his first milestone toward building lasting wealth. Michael's routine was not devoid of challenges. He often faced the allure of market fads and the seductive promise of overnight riches. But he recalled Buffett's advice: invest in businesses you understand and trust. So, instead of chasing the latest tech bubble or speculative commodities, he focused on companies with solid fundamentals. For example, he invested in a consumer goods company that had consistently increased its dividend for decades. In doing so, Michael learned that the secret to financial success lay in not only identifying undervalued opportunities, but also in resisting the impulse to jump on every bandwagon. His careful evaluation involved studying annual reports and listening to earnings calls, which demystified the jargon and revealed a story of reliable growth. This journey was punctuated by specific, actionable steps that anyone could adopt. First, Michael set clear investment criteria. Companies needed a proven track record, a strong competitive edge, and a reasonable price relative to their intrinsic value. When analyzing a potential investment, he broke down each company's performance into bite-sized figures. For instance, he calculated that a company trading at 12 times its earnings provided a better margin of safety than one at 18 times, provided both had similar growth rates. This quantitative approach, stripped of unnecessary complexity, allowed him to make logical and confident decisions, even during market corrections that scared off less disciplined investors. Michael also understood that discipline extended beyond selecting stocks. It meant resisting the urge to overreact during market downturns. When the 2008 financial crisis sent shockwaves through the markets, many investors panicked and sold at a loss. Michael, however, stuck to his plan, continuing his regular investments when prices were low. Over time, his portfolio not only recovered but soared, illustrating the transformative power of buying quality assets at discounted prices. His story provided a real-life case study in the effectiveness of staying the course, a lesson that resonated with countless listeners who, like Michael, had faced sleepless nights worrying about market volatility. Another tangible tip from Michael's experience was the importance of setting aside an emergency fund before investing. By ensuring that he had 6 months of living expenses saved, he eliminated the pressure of having to liquidate investments during personal financial emergencies. This safeguard allowed him to view his investment portfolio as a long-term project instead of a short-term cash reserve, reinforcing the idea that patience and discipline require preparation beyond market analysis. Michael's prudent financial planning meant that he could leverage market dips as opportunities rather than as crises. His discipline was further refined by a simple habit: regular portfolio reviews. Every 6 months, Michael would sit down with his investment statements and evaluate the performance of his holdings. Rather than obsessing over daily price movements, he focused on quarterly earnings and business developments. This practice not only kept him informed, but also reinforced his commitment to a disciplined investment strategy. A strategy that reminded him that steady progress was far more reliable than speculative gambling on transient trends. What made Michael's journey particularly relatable was his willingness to embrace a no-nonsense approach. He rejected complexity and flashy investment strategies in favor of clear, actionable rules. For instance, he avoided options trading, leveraged instruments, and other financial fads that promised high returns, but rarely matched the safety and reliability of simple, well-chosen equities. His candid realization that simplicity wins in investing resonated deeply with many who had experienced the pitfalls of overcomplicating their financial plans. In the end, Michael's story is not an isolated case, but a reflection of a timeless truth. Discipline and patience form the cornerstone of successful investing. The Buffett Mindset, as embodied in Michael's approach, encourages investors to take control of their financial destinies through consistent, informed, and deliberate actions. By focusing on what they can control, regular investments, well-researched choices, and a clear strategy, listeners are empowered to navigate the market with the same confidence and resilience that Warren Buffett himself has exemplified over decades. Chapter 2. Understanding Value Investing. In the realm of investing, few principles have withstood the test of time like value investing. This chapter unfolds a straightforward, actionable guide inspired by Warren Buffett's approach, an approach that cuts through the clutter of market noise and empowers everyday investors to find hidden value. Listeners are introduced to the art of deciphering a company's true worth by evaluating its fundamentals rather than its fleeting market price. Imagine a young professional, Alex, overwhelmed by the barrage of stock tips and market trends. Like many, Alex once chased high-flying stocks with flashy headlines and volatile price swings. Then, one day, Alex encountered the concept of intrinsic value. Rather than focusing on the numbers at the bottom of a trading screen, Alex began learning how to read balance sheets and income statements. Through diligent research, Alex discovered that companies with strong cash flows, prudent management, and solid competitive advantages often trade for less than what they are truly worth. This realization became a turning point, a milestone in Alex's investment journey. For those listening today, the first actionable tip is to learn how to evaluate financial statements. Begin with the basics. Assess the company's revenue growth over the past 5 to 10 years. Look beyond the surface-level figures and analyze operating margins and free cash flow. A company that consistently increases its earnings and maintains robust cash flows usually has a sustainable business model. Alex remembers opening a financial report for a modest utility company that had doubled its free cash flow over the past 3 years. Instead of being dazzled by a high stock price, Alex focused on the steady cash generation and prudent reinvestment strategies. This discipline is fundamental. Invest in businesses, not in mere numbers on a screen. Another common pain point for investors is the fear of missing out on rapidly rising stocks. The value investing strategy addresses this by advocating for a margin of safety. In simple terms, this means buying a stock at a price significantly lower than its intrinsic value. Consider the case of a mid-sized retailer that had experienced a temporary dip in its stock price due to market overreaction. While others panicked, Alex saw an opportunity. By calculating the intrinsic value using key metrics, such as the price-to-earnings ratio, which was comfortably below the sector average, Alex determined that the stock was undervalued. Over the next few years, as the market corrected itself, the retailer's stock gradually climbed, rewarding disciplined investors. The takeaway here is clear. When prices drop temporarily, they can offer a lucrative entry point for those armed with careful analysis. This chapter also drives home the importance of looking at the business model itself. Take, for instance, a well-known case study from the annals of investing history, Buffett's early investment in a small, little-known insurance company that would later become a multi-billion-dollar conglomerate. By focusing on the fundamentals, quality of management, operational efficiency, and the company's competitive moat, the early investor identified a gem. For listeners, the actionable rule is to ask hard questions. How does this company make money? What barriers to entry protect it from competitors? What is the sustainability of its earnings? Alex took this to heart by setting aside time every week to study a different company. By doing so, Alex not only built a diversified portfolio, but also developed an intuitive sense for spotting undervalued businesses early on. Next, consider practical tools. Every investor should build a checklist, a personal index card of key financial ratios to monitor. Alex's checklist included criteria such as a low price-to-book ratio, a conservative debt-to-equity ratio, and consistent dividend payouts. These specific, measurable factors act as signposts, guiding investors when the market's noise becomes overwhelming. Instead of relying solely on broker recommendations or hot tips, Alex trusted this systematic approach. The checklist becomes even more potent when paired with a focus on margin of safety, ensuring that even if the market takes an unexpected turn, the investment stands on solid ground. Finally, this chapter emphasizes that real value isn't always glamorous. It's found in those steady, reliable companies that weather storms and gradually build wealth over time. By embracing a strategy of diligent research, the patience to wait for the market to reflect true value, and the courage to act on sound principles, ordinary investors can mirror the success of legendary figures like Buffett. Alex's journey from uncertainty to clarity is a story that resonates with anyone who has ever felt overwhelmed by the complexity of investing. Through real stories, clear numbers, and actionable steps, this chapter instills the confidence to make informed decisions that can lead to enduring financial success. As the narrative concludes, listeners are left with a call to action. Dedicate time to understanding the real value behind every stock. Trust in clear metrics over market hype. And always remember that every setback can be an opportunity in disguise. This is not just theory. It's a lived experience shared by successful investors who, like Alex, transformed uncertainty into a legacy of growth and resilience. Chapter 3. The Power of Compound Interest. In this chapter, the focus shifts to the relentless, almost magical force of compound interest, a phenomenon that turns modest savings into life-changing wealth when harnessed with discipline and foresight. Imagine a man named David, who began his investment journey in his mid-20s by setting aside a small portion of his paycheck every month. David wasn't a financial whiz or a market wizard. He was an ordinary person with a regular job and everyday expenses. Yet, when he committed to investing just $300 monthly into a diversified portfolio with an average annual return of 7%, he was sowing the seeds of a future he had once thought unattainable. Over 30 years, those disciplined contributions eventually ballooned into nearly $500,000, a sum that surprised even him. This wasn't magic, it was pure compound interest at work, and it underscores a truth that anyone can embrace. Starting early, being consistent, and allowing time to do its job makes all the difference. David's approach was not about chasing quick returns or high-risk gambles. Instead, his strategy revolved around a few simple, no-nonsense rules. First, he set up an automatic investment plan. Every month, without fail, a portion of his salary went directly into his investment account. This step removed the temptation to skip a payment or to interfere with his growing nest egg. Many people share David's pain of feeling overwhelmed by market fluctuations and uncertain economic times. By automating his savings, David eliminated the paralyzing fear of missing out or trying to time the market, a misstep that has cost many the benefits of compound growth. Another practical tip David followed was reinvesting all dividends and earnings. Rather than cashing in on small payouts, he reinvested every dollar back into his portfolio. This allowed his money to work even harder by generating its own earnings, a process that multiplies gains exponentially over time. For instance, if a dividend of $50 was paid, that $50 was promptly reinvested and became another piece of the compound puzzle. In a world where many struggle with living paycheck to paycheck, David's habit of reinvesting the little extra ensured that even the smallest contributions accumulated significant value. Listeners can learn from his experience. Every dollar counts, and reinvesting dividends is like having a financial snowball rolling down a hill, gathering more and more mass with each rotation. The narrative of David's journey also serves to tackle a common pain point: impatience. Many investors are tempted to look for overnight success or chase after the latest hot tip without understanding that compound interest takes time. David's story is a steady reminder that wealth is built over decades, not days. There were periods when the market dipped, and for a moment, David's portfolio shrank. Rather than reacting with fear, he maintained his steady course, confident in the principle that over time, the market recovers and compound interest does its job. His unwavering patience was rewarded when, after years of quiet persistence, he found that his investment account had grown even during times when his colleagues were scrambling for short-term gains. An actionable takeaway for the audience is to harness the power of compound interest by taking control of one's financial habits. This means allocating a fixed portion of income to investments, no matter how small the initial amount seems. It is about making the disciplined choice to reinvest earnings and trusting the process, even when the progress looks slow. David's financial milestones, seeing his investments double over every 10-year period, became a personal benchmark that kept him motivated. His story is not an isolated incident. Numerous individuals have transformed modest monthly savings into substantial retirement funds by following similar steps. The math is unforgiving in its clarity. The earlier one begins, the larger the eventual payout due to the exponential nature of growth. The conversation about compound interest is not merely academic. It is profoundly personal. For every listener who has ever felt the sting of financial setbacks or the pressure of mounting bills, David's narrative offers concrete, relatable advice. It illustrates that financial freedom is not reserved for the gifted few, but is accessible to anyone who commits to the process. The simple act of automating savings, reinvesting dividends, and patiently weathering market ups and downs can, over time, lay the foundation for a secure financial future. Ultimately, this chapter serves as a rallying cry for a reimagined perspective on investing. It challenges listeners to think beyond short-term gains and focus on the cumulative power of every single dollar invested today. By internalizing these straightforward yet powerful strategies, anyone can harness the power of compound interest, turning everyday habits into a legacy of financial stability and independence. Chapter 4. Analyzing businesses, not just stocks. Analyzing businesses isn't about chasing ticker symbols on a screen. It's about getting to know a company like an old friend. In this chapter, listeners learn that behind every fluctuating stock price lies a real business, with its own story, challenges, and opportunities. The narrative starts by explaining that while many investors obsess over daily market noise, the true Warren Buffett approach is to study what really matters: a company's fundamentals, its management team, and its competitive edge. Imagine a young investor named Sam who, like many, once believed that success was determined solely by watching stock charts and following the media frenzy. Sam's turning point came when he stumbled upon an article detailing how deep dive research into a company's annual reports and balance sheets could reveal opportunities that the market often overlooked. Instead of reacting to short-term price swings, Sam started visiting the websites of companies, reading their quarterly filings, and even listening to conference calls. With every document, he began to understand not just the numbers, but the business's heartbeat. This commitment to learning the inner workings of companies transformed his investment strategy from one of speculation to one of careful analysis. The next step in this journey is to outline simple, actionable tips that anyone can follow. First, listeners are encouraged to begin with the company's financial statements, the income statement, balance sheet, and cash flow statement. By understanding these, an investor can assess profitability, debt levels, and cash generation. For example, when examining a retail company, one should look at metrics such as same-store sales growth and inventory turnover. These numbers provide concrete evidence of a company's operational strength. Sam learned this lesson firsthand when he compared two similar businesses, one with a transparent and steadily growing set of figures, and another with volatile numbers that suggested potential management issues. The difference, he realized, was night and day. The narrative then shifts to the importance of understanding the company's business model and industry position. Every business operates in a unique ecosystem, and successful investors treat businesses as living entities with their own competitive advantages. Listeners are introduced to the concept of a moat, that is, a sustainable advantage that protects a company from competitors. Take the example of a well-known consumer brand that built its reputation over decades. Its recognizable logo, customer loyalty, and efficient distribution network work together to fend off competitors. By digging into how these advantages were built and maintained, investors can gauge whether a business is likely to thrive over time. The story of Sam's favorite investment, once a modest company in an overlooked industry that slowly evolved into a household name, illustrates how long-term thinking pays off. The milestones were clear: a decade of steady market growth and increasing profit margins that transformed it into an industry leader. Another practical tip in this narrative focuses on management quality. It's not enough to know that a company makes money. One must also trust that the people running the company are doing the right things with that money. Listeners are urged to research the backgrounds of key executives to understand their track records and strategic vision. For instance, Sam once spent an entire weekend poring over interviews and profiles of a company CEO, discovering that his consistent, prudent decision-making was a critical factor in the business's turnaround during economic downturns. This kind of focused research provides actionable insight, a way to measure not just the company's current state, but its future potential. The chapter also emphasizes the value of understanding the industry context. An investor should ask, what are the trends in the market? Is technology disrupting this sector? How is consumer behavior changing? In one memorable account, Sam recalled how he analyzed the media industry by mapping out shifts in consumer habits, which led him to invest in a niche segment that was poised to capture a growing audience. Listening to his analysis, an average investor can see the power of stepping back from isolated numbers and instead examining the broader market dynamics. Lastly, the narrative underlines that real investing is a blend of science and art. While financial ratios and balance sheets provide a quantitative foundation, the qualitative elements, like understanding a company's culture and vision, are equally important. Sam's journey from a casual observer to a rigorous analyst is a testament to the fact that deep research and a curious mind are the true keys to successful investing. His milestones, measured not in daily stock price movements, but in informed decisions and the resulting steady gains, remind us that the rewards of patience and thorough analysis are worth far more than a fleeting market trend. This approach, told through real stories and actionable lessons, resonates because it cuts through the fluff. Listeners are invited to adopt a mindset that looks beyond the surface, to ask questions that matter, and to take deliberate steps toward long-term financial success. By following these clear, specific steps, anyone can begin to analyze businesses in the same thoughtful, disciplined way that has guided some of the world's most successful investors. Chapter 5. Emotional Intelligence in Investing. In every market cycle, one truth stands firm: emotions can sink even the best strategies if left unchecked. Take Alex, a middle-aged teacher who spent years bouncing between fear and overconfidence. When the market tumbled unexpectedly in 2008, Alex panicked and sold his stocks at deep losses, only to watch them recover years later. This chapter lays out actionable steps and real-life insights that show how managing emotions can transform investing outcomes. Alex's experience isn't unique. Investors often face the same dilemma: how to remain rational when news headlines scream disaster, or when every pundit claims it's the hottest new opportunity. The key here is to build what experts call emotional intelligence, a buffer that helps one navigate not just the market's ups and downs, but also the internal battles that come with risk and reward. One clear tactic is to implement rules that prevent knee-jerk decisions. For instance, when facing market turbulence, a simple rule, such as wait at least 24 hours before making any trades, can help. This cooling-off period lets investors like Alex pause, analyze the situation, and decide if a reaction is really necessary. By stepping away from the immediate emotional impulse, a more deliberate review can occur, often revealing that the panic was more about fear of the unknown than a rational market signal. Another practical strategy is to keep a trading journal. Many seasoned investors recommend writing down the reasons behind each trade. Over time, a journal reveals patterns, the situations when emotions, such as greed or fear, took over. Alex eventually started maintaining such a record, noting every time he was tempted by a sudden market trend. By reviewing his journal, he identified that his decisions were often driven by short-term noise rather than long-term fundamentals. This simple exercise not only sharpened his insights, but also allowed him to step back and ask, is this decision grounded in fact or fueled by emotion? In essence, the act of writing it down helps in bringing clarity and discipline to the decision-making process. For investors struggling with market overreaction, diversifying investment strategies can also serve as an anchor. Investing isn't a one-size-fits-all approach, and having a mix of assets can reduce the psychological strain during market volatility. Alex, for example, diversified his portfolio by splitting his investments between stocks, bonds, and even real estate. When stocks dipped, his other holdings provided balance. This diversification isn't just about spreading risk. It's about having multiple anchors that help maintain emotional composure during downturns. Another actionable tip lies in setting clear, predefined goals before entering any investment. The goal might be as specific as accumulating a certain amount for retirement or as straightforward as achieving a set annual return. When investors know what they're working towards, temporary market fluctuations become less intimidating. Alex found this approach particularly useful during periods of uncertainty. By linking every investment decision to his overarching goal, he could resist the lure of quick profits and focus on his long-term plan. Equally important is learning to accept that no one can predict the future perfectly. Even the most experienced investor faces losses sometimes. Instead of beating oneself up over a failed trade, the smart move is to take it as a learning opportunity. Alex recalled a trade where he ignored thorough research out of sheer impatience. It turned out to be a costly mistake. However, rather than dwelling on the loss, he analyzed every step that led to it, refining his approach and improving future performance. His story underlines a vital point. Setbacks are less about failure and more about recalibration, a chance to study why an error occurred and how it can be prevented next time. A significant part of developing emotional intelligence also involves knowing when to seek advice. Professional financial advisors, mentors, or even experienced peers can offer perspective during turbulent times. When Alex found himself overwhelmed by market noise, he reached out to a trusted mentor. This external viewpoint helped him see his emotions clearly and made him realize that a sudden drop was not an invitation to exit his well-planned strategy. In moments of doubt, having a sounding board not only reassures, but often guides a more measured response. Finally, mindfulness techniques are proving effective for many investors. Daily habits, such as meditation or even simple breathing exercises, can ground an investor's mindset. The goal is to cultivate a mental space where decisions come from careful analysis rather than emotional impulse. Alex incorporated a 10-minute meditation before reviewing his portfolio each morning. Over time, this small discipline helped him detach emotionally from the market swings, allowing clear thinking to take center stage. This chapter isn't just about avoiding mistakes. It's a call to transform how investors experience the market. With clear strategies and honest reflection, emotional intelligence becomes a cornerstone of not only surviving, but thriving in investing. Alex's journey, marked by trials and eventual steadiness, serves as a guide for anyone willing to take control of their emotions and, in doing so, their financial future. Embracing these simple yet powerful practices can mean the difference between reacting to the market and strategically planning for long-term success. Chapter 6. Risk Management and the Art of Patience. In a world where market fluctuations can send shivers down the spine of even the steadiest investor, risk management and the art of patience are not just abstract theories. They are hard-won skills that separate those who survive market storms from those who capitulate. Consider the story of an everyday investor, Tom, who realized early on that reacting impulsively to short-term market noise only eroded his returns. Tom began by setting clear investment rules. His first actionable step was to allocate a fixed percentage of his income to his portfolio each month, and then stand by that commitment regardless of market gyrations. By automating his investments, he removed the psychological barrier of making emotional decisions in times of volatility. Tom's strategy extended well beyond periodic investing. He built an emergency fund equal to 6 months of living expenses. This simple yet crucial safeguard meant that, in the event of unexpected job loss or a personal crisis, he wouldn't need to sell his investments at a loss. Instead of scrambling to cover bills during downturns, he had the luxury to let his portfolio weather the storm, a move that saved him significant losses during the market plunge of 2008, where many panicked and sold at the worst possible time. In Tom's case, while some of his friends saw their investments shrink by nearly 30%, his calm and disciplined approach allowed him to hold on and eventually reap gains as the market recovered. At the heart of Tom's approach was diversification. He didn't put all his eggs in one basket. By spreading his investments across a variety of asset classes, stocks, bonds, and even a modest allocation to real estate, he minimized the impact of a downturn in any single market. For instance, when the tech bubble burst in the early 2000s, Tom's exposure was limited because his portfolio wasn't overly concentrated in that sector. Instead, his investments in consumer goods and healthcare, which were less volatile, helped cushion the overall decline. His diversified portfolio not only reduced risk, but also smoothed out the bumps along his investment journey. Another key strategy Tom embraced was the understanding and application of a margin of safety. This concept, which he learned from studying the fundamental principles of seasoned investors, involves buying assets at prices well below their intrinsic value. Rather than following the herd, Tom would patiently wait for the right opportunity to invest in quality businesses when the market sentiment was overly pessimistic. In one memorable instance, he observed a strong company dip 20% below its historical valuation due to an industry-wide panic. Trusting his research, he invested decisively, and over the next 5 years, that decision turned into one of his most profitable moves, underscoring that risk could be managed by acting based on solid information rather than market hysteria. Patience, however, was not passive indifference. Tom's story illustrates that being patient doesn't equate to doing nothing. It means actively monitoring his portfolio, rebalancing it when necessary, and being prepared to act if a company's fundamentals deteriorated significantly. For example, one of his investments in a retail chain had shown consistent performance for years until a shift in consumer behavior became apparent. Instead of clinging to a past success, Tom evaluated the numbers, identified warning signs, a drop in same-store sales, and an unsustainable level of debt, and sold before the decline deepened. His willingness to walk away, even from a long-held position, taught him that effective risk management sometimes means cutting losses swiftly when the original investment premise is no longer valid. Moreover, Tom maintained a clear and consistent plan, documented in a notebook that outlined specific entry and exit points along with the rationale behind each decision. This simple exercise created a tangible record that he could revisit during stressful times. When market sentiments ran high and rumors swirled about impending crashes, Tom would review his notes, reminding himself of the concrete reasons behind his investments. This practice reinforced his confidence and prevented the common pitfall of knee-jerk reactions, a lesson that resonates with many investors who have lost money chasing quick fixes. Ultimately, Tom's journey demonstrates that risk management and patience are not reserved for financial gurus in a glass tower. They are practical, accessible tools that anyone can adopt. By automating investments, building an adequate emergency fund, diversifying wisely, and employing a margin of safety approach, everyday investors can construct a robust portfolio that not only weathers market downturns, but thrives in the long run. His experience shows that managing risk is a continuous, deliberate process, one that requires clear planning, honest self-assessment, and a commitment to staying the course even when the market roars. In a realm marked by uncertainty, Tom's story stands as a guiding beacon, a reminder that measured decisions, solid research, and unwavering patience are the bedrock upon which lasting financial success is built. Chapter 7. Case Studies, Buffett's Iconic Investments. Imagine a seasoned investor sitting quietly in a corner of a bustling cafe, poring over reports and balance sheets with unwavering focus. This investor isn't chasing the latest fad or leaning on hot tips. He is following a method forged in decades of experience, a method encapsulated by Warren Buffett's iconic investment style. In this narrative, the spotlight shines on real-life examples that illustrate how Buffett's approach can guide anyone in navigating the tumultuous world of investing. Buffett's journey wasn't about making impulsive decisions based on market noise. It was about patiently waiting for the right opportunity. One clear example is his historic investment in Coca-Cola. In the late 1980s, while many investors were wary of the soft drink market, Buffett recognized that Coca-Cola was not just a brand, but a symbol of enduring consumer loyalty. He purchased a sizable stake at a price that seemed modest compared to the long-term potential of the company. Today, that investment has multiplied manifold, a real-life demonstration that when you invest in businesses with durable competitive advantages, time becomes your greatest ally. Consider also the case of American Express during a tumultuous period when scandal and uncertainty had shaken investor confidence. While many saw only risk, Buffett zeroed in on the company's underlying strength. He understood that the brand and the trust built with customers provided a cushion against temporary setbacks. Here, the actionable tip is simple. Look beyond surface-level challenges. Real opportunities often hide behind temporary market pessimism. Investors can learn from this by doing their homework and sticking with fundamentally strong companies, even when headlines scream caution. In a more relatable scenario, take John, a mid-career professional who had seen his savings dwindle during market downturns. John was frustrated by the constant cycles of panic selling and hope-fueled buying among his peers. Inspired by Buffett's clear and methodical approach, he decided to change his strategy. Instead of trying to time the market, John focused on understanding the business behind the ticker symbol. He began by setting strict criteria for each investment. A company's business model must be simple enough to understand, its financials transparent, and its market position robust. By following these rules, John slowly rebuilt his portfolio. Over the years, his steady approach yielded gains that far surpassed the temporary spikes of speculative trading. John's story is a testament to the power of patience and disciplined decision-making, a fundamental principle at the heart of Buffett's philosophy. Another striking narrative comes from Sarah, a dedicated schoolteacher who started investing with modest monthly contributions. Every paycheck, she set aside a fixed amount to invest, not in the latest tech craze or risky startup, but in well-established companies that had shown resilience over time. Sarah's approach wasn't glamorous. It involved rigorous research and a relentless focus on quality over quantity. Even when market fluctuations led to short-term losses, Sarah reminded herself of Buffett's enduring advice: be fearful when others are greedy, and greedy when others are fearful. By sticking to her strategy, she witnessed her portfolio grow steadily, proving that small, consistent actions can create significant wealth over time. Real numbers provide clarity in this narrative. When Buffett invested in Coca-Cola, he committed nearly $1 billion to a company that, despite occasional setbacks, offered a long-term growth potential that was unmatched. Such figures may seem intimidating to everyday investors, but the lesson remains the same. Compound growth, when compounded over decades, can turn a seemingly small sum into a fortune. For those who have felt the sting of market volatility, the takeaway is clear. Instead of reacting impulsively to downturns, look for opportunities to buy into quality businesses at a discount. Calculate the intrinsic value of the company, understand its earnings history, and determine its future growth potential. This practice transforms market fluctuations from frightening obstacles into welcome opportunities. Then there's Tom's story, a local investor who witnessed his portfolio shrink by nearly 20% in a single quarter during a market downturn. While many investors scrambled to cut their losses, Tom did something different. Reflecting on Buffett's teachings, He saw the downturn as a chance to revisit his research and invest more deeply in companies that were undervalued. Over the next 2 years, Tom's calculated risk paid off, and his revised portfolio rebounded with gains of approximately 35%. His experience underscores the importance of maintaining composure and seizing opportunities when the broader market is in panic mode. These examples from Buffett's playbook offer simple, actionable tips for everyday investors. They stress the need to focus on long-term fundamentals, to remain disciplined, and to view each market dip as a strategic moment rather than a crisis. The message is clear. By investing in businesses you understand and by being patient, you can weather market storms and come out stronger on the other side. In a world where noise often drowns out wisdom, following in the footsteps of Warren Buffett means choosing clarity, consistency, and a steady hand. A hand that guides every investment decision with rationality and purpose. Chapter 8. Applying Buffett's Principles Today. In a world cluttered with investment noise and unrealistic promises, this chapter lays out a straightforward roadmap for applying Buffett's principles in today's market. Listeners will discover actionable tips, practical milestones, and real-life case studies designed to cut through confusion and empower them to take control of their financial future. Imagine a young professional, Alex, who came across Buffett's advice during a period of mounting debt and diminishing savings. Alex wasn't seeking a miracle cure. What he needed was a reliable, no-nonsense approach that could be applied even with a modest income. Following Buffett's principle of focusing on long-term growth rather than quick wins, Alex began his journey by adopting 3 simple habits. The first was setting aside a fixed percentage of his paycheck every month. Instead of obsessively tracking every dollar spent, he automated transfers to his investment account. This small but deliberate action harnessed the power of compounding interest, a principle Buffett champions, as each contribution quietly accumulated value over time. To solidify his commitment, Alex turned his attention to understanding the companies he invested in, a vital step that mirrors Buffett's own method. Rather than getting lost in the daily fluctuations of the stock market, he dedicated time each week to reading annual reports and industry insights. His focus wasn't on deciphering every technical detail, but on grasping the fundamentals. What gives a company its competitive edge, and whether it has a sustainable business model. Alex would say, "I invest in businesses I understand and believe in." This clarity helped him resist the temptation of trendy stocks and instead build a portfolio based on solid, measurable criteria. Another real-life example is from Maria, a mid-career professional frustrated with the unpredictability of her savings. Maria's turning point came when she realized that managing investments didn't have to be complex. Instead of following investment fads, she honed in on a handful of reliable metrics: price-to-earnings ratios, dividend yields, and revenue growth. Using a simple spreadsheet, Maria tracked these indicators for companies she was considering, setting a clear, systematic process to evaluate each opportunity. By committing to this routine, she not only reduced her financial stress, but also achieved her first significant milestone, doubling her initial investment within 8 years. The lesson was clear: disciplined, methodical analysis beats chasing the next big thing. Listeners can also relate to the struggle of balancing day-to-day responsibilities with long-term investing goals. Consider the story of John and Lisa, a couple who managed a tight budget while raising their 2 young children. They decided to implement Buffett strategies by cutting unnecessary expenses and redirecting those funds to their retirement accounts. Their approach was pragmatic. They began with small adjustments: a modest reduction in dining out, more energy-efficient home improvements, and a commitment to pay off high-interest debts first. Over a few years, these cumulative changes not only improved their cash flow, but also provided them with the financial breathing room needed to invest in diversified, low-cost index funds. John and Lisa's journey reminds us that the path to wealth isn't paved with grand gestures, but with incremental steps, where every dollar saved today plants the seed for future growth. Crucially, this chapter emphasizes that investing isn't reserved for Wall Street insiders. Using Buffett's philosophy as a guide, anyone can start by simplifying their approach. Begin by stripping away the confusing jargon and focus instead on establishing clear, measurable goals. Whether it's setting aside a fixed saving percentage, regularly reviewing a few key financial metrics, or building a habit of investing consistently regardless of market sentiment, these are the real, tangible steps that have generated wealth for generations. One actionable tip for the listener is to adopt a money index card mindset, much like what's popularized by resources like the index card and the practical wisdom of Mr. Money Mustache. Write down 3 critical principles that matter the most. Save regularly, invest in what you understand, and avoid unnecessary complexity. This simple exercise serves as a constant reminder of the core values that drive financial success. Each time a decision arises, be it a tempting sale on a gadget or an impulsive stock pick, the index card's principles act as a filter to reinforce rational, long-term thinking. Another milestone that stands out is the idea of celebrating small victories. As Alex, Maria, John, and Lisa have shown, the journey to financial stability is marked by incremental achievements. When an investment portfolio grows a little or a debt is paid off earlier than expected, take a moment to acknowledge the progress. This recognition not only boosts confidence, but also reinforces the importance of sticking to the strategy, even when the market seems turbulent. Ultimately, this chapter drives home the message that Buffett's time-tested principles are not relics of a bygone era, but practical strategies for today's investor. By keeping things simple, disciplined, and fundamentally sound, anyone can build wealth steadily over time. Listeners are invited to take these actionable steps, adapt them to their personal circumstances, and transform their financial lives, one deliberate, measured decision at a time.